Ultratech Cement, for instance, example, highlighted demand being linked to the broader slate of public investments that were happening. There is overall new investment proposals rose to around $15.7 trillion. Domestic private Indian companies' commitments have also fallen to about 15.6%. Well, India's story in terms of Capex has been quite disappointing in the private sector. For much of the past 10 years, India's growth story has been imbalanced. The economy has grown exponentially. Headlines have shown that the Indian economy is very bullish. Foreign investors have also invested in India. The country's private sector, however, has remained a little hesitant in terms of scaling up, spending capital, doing R&D, which is something that you would expect from a fast-growing nation. Naturally, the government has sort of stepped in and led to a lot of infrastructure projects, which is why its government capex has increased. And there are obviously select pockets within the private sector which are investing aggressively. Overall, it looks like the private capex spending hasn't really going up and it appears to be falling. So today we'll look at why does private capex matter, what exactly are the reasons for the government spending more and the private sector not spending more. Have we sort of seen a bottom of this private capex decline? And where do things look like from here on out? So let's get into it. So what is private capex? Private capex is the money that companies, businesses spend on long-term capital assets or productive assets. Think of factories, plants, machinery, logistics, capacity building, R&D in terms of facilities and new technologies, and any other investments that require a significant amount of capital and typically have a longer duration. A lot of that equipment, a lot of that capital that goes into this helps the economy's ability to continue to produce and to employ people in the economy. Now, unlike consumption, which is very sort of focused on a somewhat of a short-term phenomenon, it actually is building supply for the future. And unlike government capex, it is usually tied directly to commercial demand and tends to be a self-reinforcing cycle of more jobs, more income, repeated investment. And that's how it goes. And this is also a reason why many economists kind of obsess over private capex. It's a growth model which is dominated by public infrastructure, can only lift demand for, let's say, infrastructure related items such as cement, steel, construction services, etc. But when you look at a more durable model where companies themselves are spending on building capacity because they see more demand in the future, they see stability, they see more certainty of certain outcomes happening, and ultimately what they're looking at is a more profitable demand future. So now that we understand what private capex is, today where we've gotten to appears to be that India's infrastructure boom has sort of masked the overall capex slowdown that's happened. In materials like cement and steel, many companies and executives have pointed out the long pipeline of infrastructure that's there, the real estate activity that's available. So Ultratech Cement, for instance, example, highlighted demand being linked to the broader slate of public investments that were happening, and that was ultimately tied to the government's infrastructure push that's happening. JSW Steel, another player in the steel industry, also cited a similar story of the India story where there's construction, infra, commercial real estate, renewable projects, defense, railways, etc. And a lot of that require and specific consumption categories as well, and that's where their demand is coming. So strong demand for building materials, etc. can coexist with private capex if the primary engine ultimately is the public spending rather than private capacity expansion. And that's exactly what's happening right now. So if you look at data points, what we see is private investment as a share of GDP peaked around 27% in the boom of 2007 to 2008, then again around 2011 to 2012, but post that it's sort of been declining. And the private sector's share of total fixed investment shrunk from about 40% in 2015 to about just 33% in 2023-24. That is a structural change that has happened in India's private capex spending. So new private capex has also fallen. Recently, the data that we're seeing shows for 2 consecutive quarters, including October-December of 2025 period, private capex has fallen. There is overall new investment proposals rose to around $15.7 trillion as government projects rebounded in the third quarter of FY26. New government investment projects also jumped by about 26-27% quarter on quarter to about $5.64 trillion, lifting the public sector's share of proposals to nearly 36%. However, private sector investment plans fell about 4.5% quarter on quarter after a sequential contraction in terms of the poor quarter that they saw. Domestic private Indian companies' commitments have also fallen to about 15.6%, which is around 7.76 trillion rupees. And finally, foreign investors have been offsetting a lot of this weakness with fresh investments sort of surging upwards of around 70%. Overall aggregate pictures looks fine because of a lot of these moving parts from the government to foreign investors, but domestic private companies have been very cautious in terms of their spending. So the natural question is, why are private sector companies holding back on their investments? Well, this private sector capex crisis is better understood as a mix of demand uncertainty, balance sheet psychology, and the overall global risk that we're seeing right now. So there are four fundamental reasons. One of the first ones is demand confidence has been patchy. Capacity utilization for many of these companies sits at about 75%, which weakens the incentive for them to add new capacity, because why would you add another factory if your existing lines aren't necessarily running at the optimal 85, 90, 100% mark? There's also stagnant real wage growth, which has been a drag on consumption demand, which ultimately feeds into the corporate caution that we are seeing as well. Second is that earlier there has been an aversion towards debt in earlier cycles. So many corporates may have scars of earlier corporate stress, credit stress that has happened, which means they're wary of taking on excess leverage or leverage at all. And what we're seeing is across the board, we're seeing low net debt multiples among many large non-financial firms and a trend towards zero net debt postures as well. With the rise of family offices, financial investing as an alternative to capital-intensive projects, especially when equity and digital economy returns appear attractive relative to the grind of industrial execution. So what is happening is the shift towards areas where returns might feel more safer. And finally, the global headwinds, the trade uncertainty that's involved. There's obviously a link between the near-term caution that many corporates are playing in terms of the broader risks that are there in terms of tariff risks, the geographical uncertainty that's happening, and ultimately a softer export environment as well. So a lot of those factors are delaying any big ticket commitments from these corporates when domestic conditions may still look great. And one of the most interesting things is that we saw a direct official signal come when there was a forward-looking survey that was conducted by the Ministry of Statistics and Program Implementation on companies' private capex intentions. So there are about 3 points we'll highlight here. The first is the survey noted a 25% year-on-year decline in intended private capex for FY26, and the responding enterprises also fell year-on-year, and the survey itself excluded many smaller firms and certain vehicles, etc. So it may not fully capture the full universe, but as a directional indicator, what it showed and reinforced the same message that Indian corporates were planning conservatively. So can India's private capex recover? India is already seeing acceleration happening in certain pockets. First, public capex is increasingly being designed to crowd in more private investment. India's latest budget also raised infrastructure spending to a record 12.2 trillion rupees, while explicitly aiming to bolster growth amid global volatility. Now, whether you sort of are pro or are critiquing this public-led growth model, what it really means on the ground level is there will be more roads, better ports, more rail, more power, more logistics. All of that should help lower costs, transportation costs, logistics costs, and ultimately raise the viability of any private projects that are taken up. Second point is that the foreign investor cushion isn't necessarily trivial. Foreign investment has jumped sharply as domestic companies have pulled back, and many of these global capital providers are willing to fund projects, even though it's selective, to keep the overall ecosystem moving, such as when suppliers invest in, let's say, skills are deepening, clusters are forming, and ultimately we might see the domestic players sort of come back once that uncertainty fades off. Third point is that there is this next economy capex themes that are getting more clear. Domestic players are also starting to participate in that along with the foreign players. So many multinationals, major Indian players are pouring money into renewables, AI, data centers, a lot of this new age technology now. And even if the broad-based industrial capex remains cautious, these sectors can demonstrate larger effects or new supply chains may get created that eventually will have a spillover effect into India's other sectors in terms of manufacturing, electronics, grid equipment, specialized construction, etc. etc. Finally, in terms of the overall capex cycle, it appears that we could be or may have already crossed the floor or the bottoming of it, then rather than being at a peak of fear. When private capex have dropped for consecutive quarters, what it means is that there are delays in decisions that are being made rather than those decisions sort of just being cancelled permanently. And when domestic conditions are described as being stable, inflation is being managed, and the real blocker here might be the global uncertainty. Then we can sort of start seeing maybe trade starts getting normalized, utilization, the capacity utilization starts inching back up to a much higher number. So many of these corporates will start moving from just a wait and watch approach to actually being involved before other competitors and other players enter the market. So the final question here is, has India's private capex actually bottomed out? Well, India's story in terms of capex has been quite disappointing from the private sector compared to where we would like to be. If you look at the last decade, what we can see is that private capex hasn't really nudged even when there have been decent amount of tax cuts and even liquidity is available and are not able to sort of force companies to invest. The next phase that we're looking at here could be something a little bit more simpler but more powerful, which is to rebuild the confidence that demand will continue, costs should fall over time, and overall the uncertainty that exists should sort of fade as things progress. Now, when that confidence does return, private capex will sort of start growing faster, and that's why despite any real slump that's there is a credible case that India's private capex cycle might be bottoming out soon, if not already, because the overall ecosystem is slowly aligning to make the next wave of private investment maybe less risky and ultimately a bit more inevitable. Thank you so much for watching. If you like the video, do like, share, subscribe. Let us know in the comments what else you want us to cover next. Thank you so much for watching. Happy investing and take care.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.